All right, episode 9 of the What Do We Do podcast. Kyle Bogey, Dewey Stefan with you here at Great Lakes Wealth, and we appreciate the support you guys have given us here through the first 8 episodes. A lot of good financial advice. I know the previous episode we kind of took a deep dive into gold, but Dewey, I'm having a blast doing this, and we got a lot to look forward to today.
Episode 9, and like I've been saying each week, we're just getting started. This is fantastic, and I'm so excited for today's episode.
And because it's summer and sports are starting to, officially make their return, we are going to spend a little bit of time, getting back into the sports world and, looking toward baseball season and everything that goes along with it. So we will be touching on that a little bit over these next several episodes. But to start, we do want to dive right into something that is, I think, very relevant, especially with what's going on, over the course of this last year with the market, with the economy, and the amount of jobs lost out there, and that is investing. And there's obviously a difference between growth investing, income investing. We'll take a look at both facets of that. We had a great question, actually, that was asked of us on the Facebook page, so we'll make sure to do that.
Yes, right. There's all types of styles and all ways to invest, but today we're going to kind of just go straight forward with income investing and growth investing. And there's all sorts of subsets, but today we'll kind of keep it simple, stupid, if you will. KISS.
I like that.
KISS. We also here at Great Lakes Wealth say KISS, keep it safe, stupid also. So we will do the KISS, and we're going to go a little bit into income investing versus growth investing. The truth may lie somewhere in between if you're a diversified investor, but we'll get into it for sure.
And again, we appreciate you guys downloading, subscribing, rating, sharing, all of it, and we appreciate the feedback you guys have been giving us as well. So let's go ahead and just get started here with what we just basically touched on. So there was a question that was asked, earlier this week of the approach that you should take if you're looking for income versus long-term growth. And then, of course, vice versa. And I think this is fascinating because this has been one of those years where the market went way down. And so people were clearly thinking long-term, but also thinking about trying to make some money along the way and maybe cash out a little bit. I guess in your expert opinion, what is the biggest difference between income investing and growth investing, just to get started here?
Well, and off of that question that came in kind of hits to the point, which is, do you put all you have in one time? Go for it, all in, versus in piles or dollar cost averaging, it's called, a little bit at a time over time versus one big pile in. So that was kind of got me thinking about it. And on the income side, are you trying to generate income to subsidize your current income, or are you trying to grow your assets in your portfolio? Here, we also sometimes ask clients, are you trying to make a killing, or are you trying to not get killed, right? Are you trying to become wealthy, or are you trying to stay wealthy? So it really depends on where you're at and what you're trying to accomplish. So, to answer the question succinctly, income investing is really for those that have the pile of money that they would need to live off the interest, if you will, or the income that's generated and not touch the principal, versus growth investing, I think, is more for those that pile of money doesn't need to generate any type of cash flow for the person who's investing it. Does that make sense, Kyle?
Yeah, absolutely. So growth investing would be more so the long-term, waited out, you're not going to touch that money for 30, 40 years essentially until you're retired type of situation?
Yeah, typically. Everything's subject to change, but typically. Warren Buffett has a great quote, which is, if you don't find a way to make money while you sleep, you will work until you die. How does that sound, right? And we talked about this in a prior episode. The average millionaire has 7 streams of income. 7 streams of income. And that income comes in different categories, if you will: active income, passive income, retirement type of income. 10 broad sources of that income would be employment income, if you're still working. I think we're all working right now. Capital gains income, interest income, dividend income, rental income, royalty income, guaranteed and tax sheltered income, 401k, IRA, retirement income, pension income, Social Security income. A lot of different sources of income that you could have to subsidize your employment income or just your monthly, expense needs, right?
Mm-hmm.
And so along those lines, there are government bonds that you can invest in. And right now, a government bond, depending on how long you go out, may only pay you 2% interest for 10 years, right? 2% interest per year for 10 years for a 10-year treasury. Not even quite that high, frankly. But in that case, $1 million that you put into a 10-year treasury, you're only going to get $20,000 a year of interest to live on.
Mm-hmm.
Right? Less than $2,000.
Probably not enough, yeah.
Probably not enough. You're going to dive into the principal. You follow me?
Mm-hmm.
Versus a different type of bond, a corporate bond. Maybe you can get 4% interest, but then you have to worry about, is that corporation safe and sound and this and that and the other. So 4% interest, now you're talking $40,000 a year on $1 million. And you can get high yield, or what they call junk bonds, and maybe you get 8% a year on your money. And now you got, $80,000 a year if it's an 8% bond. So that's, again, analyzing what you're going to live off of or monthly cash flow versus in the growth investing scenario, that $1 million may not pay any interest out per year and will grow. A great stat that you and I talked about before the show was Amazon. You've heard of Amazon.com?
Very familiar, yes.
Okay, great. Well, it went public back in, I think, 1997. May 15th rings a bell. If you would have put $10,000 in Amazon.com company stock the day it went IPO, and you just let it grow, there were no dividends paid out, nothing that came back to you, you would have had May 15th of this year over $12 million. 10,000, 13 years later, 12 million. Here's where it even gets more crazy. Because of the number of shares bought back then, the price May of this year was around $2,400 a share. As of, yesterday or today or tomorrow, call it $3,000 a share. You actually have closer to $20 million. So an extra $8 million between friends in a few months of investing because of what you did way back when in the growth investment of Amazon.com. That's insane.
And I'm assuming you have the next Amazon already in your back pocket, right? Like, how are we going to pool some money together and turn it into $12 million over the next 23 years? You got to have a couple of companies, right?
Well, I would tell you again, there are going to be a couple
but then you'd
companies
have to kill
out
me.
there. Well, we're rolling up our sleeves and we're doing the work, and everything's changing by the day. But there absolutely will be some of these growth companies that are, brand new, infant, small cap, whatever you want to call them, that absolutely will probably have that same, type of trajectory. Can't say 10,000 to 12 million, but regardless, that's the benefits of investing. Straight. What's the right word I want to say? That's the benefit of investing. Simply put.
Yeah, you kind of mentioned it. With Amazon, we'll just use them specifically. But you said in May, $2,400 a share. Now, up to, $3,000 a share, again, an extra $8 million potentially if you had invested that $10,000 way back, in 1997 and capitalized on that. So is that the opportunity that you're talking about right there too, where it is income investing, where if you see a company like Amazon, other companies that dipped while the market was down, you invest in them knowing full well, or at least you had a hunch that over the next couple of months they were going to get back up. And at that point, you cash some of that out. Is that kind of along the lines of income investing a little bit?
It can be, but not really.
Okay.
I mean, that's more, timing the market or just taking advantage of opportunities. And that would be whether it's in investing in the stock market versus, even buying real estate. If you bought a house and then, 3 months and you plan to live there forever, and then 3 months after you bought it, someone came around, knocked on the door and wanted to pay you twice what you paid, you'd have to decide, well, we were going to stay here forever versus I'll take that cash, right? And so a lot of it's dependent on future events that happen. That's why we are saying now is the generational buying of opportunity of a life, generational buying opportunity for investors. for short-term, medium, and long-term, because even though the markets come roaring back from the depths of March 23rd, the height of the COVID crisis meltdown, we're still not back to even on the year, let alone, I would imagine in the coming months, there'll be some other pockets of weakness of investing, opportunities to find, to where a year from now, 3 years from now, 13 years from now, 23 years from now, you're going to have, a much larger pile than you have today, not even close.
So when it comes to growth investing and long-term, investment opportunities, if you're fortunate enough, to be able to have that 401k and have that retirement, maybe you do have, an employee or employer match, program, whatever it may be. I'm assuming on top of something like that, if you are financially inclined, being able to find investments that can grow over the next 30, 40 years and maybe be a little bit safer, that's something I'm assuming that you would advise, people doing as well, and that's more what the long-term, growth investment is.
Yes. On a side note, when you're talking about 401k or retirement plan investing, you have your current pile versus your future contributions, right? The current total allocation, bottom line portfolio value versus what you're going to be adding this Friday or every other Friday. So depending on the size of that current pile, and the time until you are going to retire, you definitely want to dial up or dial back and analyze your portfolio mix so you didn't have your entire retirement balance in growth investing, March 1st of this year, we talked about in the prior episode. So a lot of it is dependent on, again, talking to a professional or going to greatlakeswealth.us and playing with our calculators. We will help you figure out the perfect mix. No one should have 100% into growth investing with any type of pile that is substantial. And also, I'd argue that no one really needs to have all of their money into income investing where there's no potential for appreciation. So, the typical mix would be 60-40 of stocks and bonds or growth versus income, but it's all dependent on who the person is and what they're trying to accomplish.
When it comes to growth, I mean, is there, every situation's different. We've touched on this a little bit, but is there a specific percentage, that you kind of lean on or point to that, hey, every single month, this percentage, even outside of your 401k, and, unless you want to count that, has to be going and being put away, as an investment and something that can grow over time? Is there, I guess, a model for what you would say for someone trying to figure that out?
No, because every person's different. So it's going to come down to what are you trying to accomplish, right? So if we go just back to basics with growth investing real quick, in general, growth investing refers to investing in companies growing their earnings at above average rates. They may not pay out any income. They may not pay out any distributions. Another word for income. You familiar with that?
Mm-hmm.
Okay. And so there's two major advantages of investing in growth stocks or in growth investments. One is the expected or potential for large appreciation, right? If you invest in an acorn, if you invest in a seed, if you invest in an acorn, right, an apple seed, if you will, got to start that over. If you invest in an apple seed and put it in the ground, maybe it costs you 10 cents. Well, if you water it and put some sunlight on it, that seed will grow into a sapling, and then that'll grow into ultimately this big old apple tree. Takes many, many years, 23 years if it's the Amazon apple tree, and actually it should be the apple tree if that's another company. I digress. But with that, right, you want huge growth opportunities, and that's what, again, growth investing means. Number two is, besides the long-term potential huge capital gains, also is some tax treatment too. Income investing, you typically have to pay income tax, and there are exceptions to that, versus growth investing is long-term capital gains, which are at this point much more at a much better better detailed tax treatment. A much what's the right word I'm looking for? A much they're at a much more what's the right word I'm looking for here?
Advantage, a greater.
Yeah, they have a much better tax treatment than income investing. All that to say that if you need to live off of any of that investment, you're going to actually have to sell out or take out part of your investment, and it's not given to you in terms of a distribution or income. You're actually going to have to sell part of your investment, and maybe that defeats the whole purpose.
Have we seen more of that this year, just based on what's going on, based on the market, going as far down as it did, or are people pretty comfortable just keeping their money in, staying, waiting until it gets back to, the heights that it was at before? Or are we seeing more people take some out? And, has it changed a little bit this year because it's so unique?
Hi, this is Dewey Steffen, CEO of Great Lakes Wealth. Are you interested in investing but aren't sure where to start? At Great Lakes Wealth, our mission is to provide Wall Street solutions with Main Street values to our clients and the communities we serve. We offer a qualified, experienced, and dedicated team to each and every client. We work with conservative, moderate, and aggressive investors and strive to help them reach their financial goals. So if you have at least $100,000 to invest, please visit our website at www.greatlakeswealth.us or call me, Dewey Steffen, at 248-378-1200 to learn more. Thanks for listening, and I hope you enjoy the rest of the show.
So I really don't know how you measure that. I know there are ways to measure that, so I'm not really sure of the answer, but definitely volatility creates opportunity, and there are people who are buying and selling all day long. Here at Great Lakes Wealth, we also understand that in Wall Street jargon or in financial planning speak, it's not timing the market, it's time in the market that creates your success. Have you heard this phrase on Wall Street? Right. So we understand it's there, but we kind of say it's not necessarily 100% the case. If you can time the market and get in and get out and get in and get out, then you absolutely can take advantage of these opportunities, even more so. Now, the problem is most people can't time the market successfully, and there's a lot of data that shows that. But in major drawdowns, like we had in the spring of 2020, you're supposed to be buying more, right? Buy low, sell high. So depending on what your circumstance is, you should be rebalancing, and that rebalancing can take effect very rapidly if something depreciates and then appreciates. Make sense?
Absolutely. All right. So tie in, I guess, overall, okay, let's focus on growth investing for a second here and just kind of a brief summary, a Dewey stamp here of what growth investing is in your mind and what people really need to know about it moving forward.
So growth investing, from my perspective and our perspective here at Great Lakes Wealth, is investing for the long term to grow your capital without any need for short or medium-term income off of it. You can certainly, again, take it if you need it, but that's not the approach to growing your assets, right? And the big thing behind that is not taking out a little bit here like you may have when things go up and taking a little bit out to pay your bills or to do something else. The whole idea is to leave it in, and then it's compounding, right? The growth compounds. If there is a dividend that's paid, or if the return you make continues over a long period of time, compounded growth is what takes the $1 million and turns it into $2 million. If you only make 7% a year straight line on $1 million, you follow me, over 10 years, right? So let's say a 7% return on $1 million, $70,000 a year. If you just get that simple interest, and that's now we're talking income investing versus growth. But if you had a 7% return for 10 years and it just went up 7% and you took the 7% out, you sold it, you would have $700,000 of gains after the 10 years. Do you follow me?
Yeah, absolutely.
Simple interest or simple growth. Okay, the word simple. Compounded, if you had that 7% over and left it in, 1,070,000. Then the next year, you don't just have 1,140,000. You also have some compounded growth on that first 70. You would then have approximately $2 million by the end of the 10 years. So it's not quite 300,000. It's a little bit less, but you can understand there's several $100,000 of compounded growth. And in fact, another quote that I love comes from Albert Einstein. And he famously said, "Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it."
That's fantastic.
Right, and so the final part of the investing for growth or compounding your returns would be that of the dollar cost averaging. And so if it's in your 401k or any type of account where you can just put in consistently, you're going to have an investment that if the market goes up and down, up and down, up and down, up and down, as we talked about in a prior episode, some weeks or periods when you buy, you might be buying higher than when you bought initially, but other times you might be buying lower. So the average cost over time is typically lower because the markets or the investment that you would make typically, even with Amazon, doesn't just go straight up in a straight line. So by dollar cost averaging, that's a huge, huge investment tool to get to that compounded return goal of financial success.
Okay, so I guess we can wrap a bow on income investing as well. If you had to summarize and say, this is the specific thing that you need to know if you're going to be potentially participating in income investing, what do you need to be prepared for in doing that?
So income investing, if you're going to live off of that income, then you need to have a much larger starting point pool of money. Right? If you want to just live off the interest or live off the income, you're going to have a much larger pool to generate that amount of income.
I mean, who
right?
doesn't have $1 million in the bank, right? You know?
Well, again, if you've got your seven, silos, you've got your 7 sources. You're one of those in the select group.
You're getting there.
You're getting there,
You're
right?
in the club. Yeah.
Right. So income investing then breaks down to the amount of safety that you're taking with your investments. So income investing, you can put it into government bonds. They're guaranteed and backed by the U.S. government. Again, a 10-year treasury is under 2% interest per year now, right? You also could get bonds that are municipal bonds that are backed or insured from municipalities or other agencies, and those would be tax free, but they're having a lower amount of interest that's paid out. Behind that would be corporate bonds. So you can invest in bonds from private or public companies, and those would pay more than the government, but they're not guaranteed or insured. And so let's say you can get 3% versus 2% from the government bond. So is $30,000 a year from the government bonds on your million worth it versus $30,000 from the corporation versus the $20,000 from the government bonds. The next one on the list would be real estate investing. You can do it through investment vehicles like ETFs or through these things called REITs. You can invest in real estate and maybe get a 5, 6, 7% return on your money. Obviously, investing in real estate may not even be liquid, but even if you can get in, it might be more risky than investing with the U.S. government or with corporations. Follow me, Kyle?
Absolutely.
Okay, so then the next one would be high dividend stocks. So income investing in some stocks that are built to just generate dividends, typically known as utilities. Again, these REITs, other income generating stocks, you can maybe get 6, 7% return, but you're going to be subject to the principal fluctuating. Next on the list would be mutual funds that have a combination of different interest bearing vehicles. Same thing, 6, 7% interest, but you're going to have to deal with the daily fluctuations of your principal. You do have MLPs, which are master limited partnerships. They can be specific to industries like energy. They have to pay out most of their earnings. They don't necessarily get complicated, but they have sometimes income streams up in the 8 or 9% interest. But now you're talking potential risk of permanent loss of your capital. So the more you try to make an interest, the more that you may be losing your investment. Now all of a sudden it really wasn't an income investment like you thought. It's more of a growth investment that just didn't work out. Right? What do you think about that?
Yeah, I mean, it's just so really every situation is completely different, and it comes down to what you're trying to get out of your money. But overall, what I'm kind of getting out of this is the growth investing, taking your time, not looking at the money, not doing anything with it, just allowing it to compound and grow. That's going to be your safest and best bet if you don't need that money in the short term.
Again, it depends. So yes, common sense or simple sense, or I guess just discussing it through maybe, but nothing's 100% one way or the other, right? So it really depends on the opportunity that's there. I would argue right now, Kyle, that maybe parts of the stock market in the short term are too high. So you're going to invest in growth stocks today. Amazon is over 3,000 a share. It could come back to just where it was in March, as we talked about, or was that May? It was back to where it was in May that we talked about, from 3,000 a share to 2,400 a share. You basically will lose 20% of your capital right out of the gate, right?
Crazy.
So again, timing is part of it, and maybe you just buy a little bit of Amazon right now. Big shot like you at 3,000 a share instead of buying 3 shares for 9,000. Just buy 1 share today, see what happens, and then buy another share and then another share. So it's not as simple as just, hey, well, I think long term, if you have all the time on your side, you might as well go with growth investing. Not necessarily the case at all, right? And along those same lines, you don't even have to be invested in the stock market. On the income side, you could invest in a private small business. You could become a franchisee, of a fast food franchise or a dry cleaner franchise. I don't know if I would do that now with everyone working from home. But at the same time, it's not always investing just in public vehicles. A lot of people invest in real estate, because real estate, if you have an apartment building or even a single family home that you rent out, right, that tenant pays you income on a monthly basis. So another benefit of income investing is potentially actually the appreciation that goes with it. It wouldn't be growth type of returns, but again, if you buy some real estate, you hope that real estate value, the property value, goes up while that tenant is also paying you that rent. So it's not black and white. It's not all one way or the other. Again, truly a diversified portfolio. Here's where we go with the bottom line, Bogey. The bottom line would be a truly diversified portfolio has a common combination of growth and income, cash, bonds, stocks, real estate.
Hit it from all angles.
As we talked about last week, even some gold and precious metals. Gold doesn't pay any income, and it may not even grow. It just might be your ballast in times of distress. So I'll leave it there in terms of growth versus income. You need to actually have a diversified portfolio. And as we've said before, take your age minus 100, and that's what you should have in one of the piles, right? So if you're 60, you look really good for 60, Bogey. Okay, if you're 60,
my back feels like I'm 60, but go ahead.
Subtract 60 from 100. That 40 that's left, that should be perhaps in the growth side or the stock market side of the equation, and the 60 should be in the more safe, sound income side of the equation through, again, bonds that are not high risk and considered junk or whatever the case. If you're 80 years old, you should still have 20% in our approach into growth investing or stock market investing. Again, typically, so seek counsel from your financial advisors. Again, go look at our website for the calculators, and we wish everyone fantastic success.
All right, well, a perfect transition here because we got to talk about a little bit of baseball. You brought your old English D quarter zip that you got there, the Nike one, and baseball is officially back. Now, it was a pretty nasty public back and forth between the Players Association, the owners, the league, everything that was going on with it. But now that it is here, 60 games, sprint to the finish, there is a little bit of excitement. Even for me, who's as cynical as they come, you got to be fired up for baseball to be here.
I am ecstatic that baseball is back in the D, Bogey, right? They just played their home opener yesterday, right? It's here, fired up.
Little different right now, but that's okay.
Yes, there's crickets at the stadium, but on TV, baseball's back.
Okay, so what do you expect out of this 60-game slate? Obviously, the Tigers are not trying to win right now, even though they did make a couple of, one-year free agent signings in the offseason. C.J. Cron adding a little bit of power in the middle of that lineup. For, the 20th straight year, Miguel Cabrera looks like the best shape he's ever been in his life. Who knows what you're going to get out of him? But I will say, for me at least, the starting rotation for the Tigers, Spencer Turnbull, see if Michael Fulmer is actually ready to go. Matthew Boyd has been good. I don't think he'll ever be, this great pitcher. And then we'll see the mystery that is Casey Mize. Is he going to be up with the club? Is he going to be sent down? How is that whole thing going to, unfold? But if you have starting pitching, and we know this as well as anyone, from '06 all the way up until 2014, you can compete. I don't know that Tigers are there yet, but starting pitching is going to give them a chance in a 60-game condensed schedule to at least be around for half the season, I think. Tell me I'm wrong.
This is your wheelhouse. So I'm going to actually just ask you a few more questions to dive
Perfect.
deeper, okay? So, what is the outlook for the Tigers this year from your perspective? I'm certainly aware of the pitching and the pitching rotation, the opportunities that come with solid pitching. But you also need the hitting, right? And you need 9 players that are coming to work every day and producing. So in this town, we had back in 1984, baby, bless you boys. And then from '06, with the last run that we had, how fantastic was that? Getting to the World Series and then just getting swept, right?
Should have won it. Unbelievable.
Right.
Yeah, go ahead.
But anyway, with that, I mean, what are your predictions, for the year, yours, but also maybe what are the team's expectations? Are they, it's one of those things, well, is it still a rebuilding year? Are we in like the 5th or 4th, whatever the number is this another rebuilding year? Is it making the playoffs is great, wild card? Is it winning a pennant? Is it going all the way to the World Series? I mean, what is it?
If I had my druthers, I'll at least just say this. Lose as many games as possible, get that number 1 pick again, right? I mean, that really is the best thing for the organization moving forward. But we haven't had sports in months. You have 60 games. For the first time ever in baseball, every single game matters, okay? And I think that's going to be really good for the sport. I think it's going to make them really look at potentially reducing the amount of games they play moving forward from 162 maybe down to like 130, 120, because it was cluttered. Playing every day, those games don't necessarily matter as
Kyle,
much.
let me interrupt you. There's this thing called cash, baby. It's
There
all
is.
about the money, okay?
And these owners are very much about the money. Obviously, we saw that play out publicly, over the last couple of months. But in a 60-game season, can a team get hot? Can a team ride, a strong starting rotation, add in some power there in the middle of the lineup with the Minnesota boys that they brought in? I mean, C.J. Cron has had a few home runs here, in the summer training period or whatever you want to call it out of Comerica Park. Can Miguel Cabrera actually, kind of find his stride again? I don't know. He looks great, sure. What does that ultimately mean? I don't know. Maybe playing a 60-game condensed season for him is something that he needed, here moving forward, where he can be, healthy for that, entire period of time in the middle of the lineup. That would obviously be huge for this team, but it does come down to the outliers, the other guys. Can Jacoby Jones get his back going? I don't know. We know what he can do, certainly defensively, but there's a lot more, that goes into being a quality major league player. You got to be able to do it all. So I'm intrigued to see that. I would imagine the Tigers are probably going to be in it until maybe the 20th, 30th game, something like that, and then maybe things kind of fall off a cliff. But I think there's going to be moments that fans look at it and go, well, this is exciting. There's some young players out there doing well. Hopefully Casey Mize is starting, every 5 days, whatever it may be. We get glimpses of some of these young players, maybe a Spencer Torkelson. I doubt it, but, those are things that I'll be looking for and I'll be excited about. They're not making the playoffs, at least in my mind they're not. But if they can give us a few nights, even with the Crickets out at Comerica Park, like you said, that'd be great. Why not? We desperately need sports.
Well, we definitely need sports from my side of the table in terms of just the the mental opportunity that's there, right? Whether you're watching them at home, we talked about this in a prior episode too. There's just nothing to watch. It's a soccer match from 2007. It's a baseball game. I think I was watching an NBA Finals from 92 the other day on one of those. Archived ESPN shows, whatever the case is. So just having it back, right, I think is really important just for people's mental state of mind, right? But I will say the main reason that Detroiters love going to Comerica Park to watch baseball in the summertime when the team's not expected to compete is because the weather's outside, you got the vendors, you got the Ferris wheel, you got the merry-go-round, you got the experience. Right, so it's back, which will be great to watch, especially if you're a baseball fan. But for the family to go down there is part of it that's still going to be missing. And on that point, then there's the economics, right? The money that the city of Detroit so desperately needs that comes from the revenues generated for each home game, from the people that work there at the stadium to the local businesses surrounding the stadium. That's the part that, too, they'll be playing. But I can imagine there's some restaurant owners and some bar owners that are going to be kind of, grumbling. And so that is what it is. But at least we got the ball rolling, so to speak. We got a little bit something to look forward to. It's something that's here.
That's it, and obviously we can pay attention to some of these young kids, hopefully get a look at them. Big year for Jamer Candelario, too. Is he going to be a part of the future in this lineup? He was that 4A player with the Cubs before they traded him here. He kind of needs to get the bat going again after initially being very good and showing some power when he was originally traded here. So a lot of things to look for. Obviously, you want to see the foundation be built with the young players. You want to see if these veterans can, get it going, but either way, we can sit down, we can watch a game. It's going to look and feel different, but that's okay.
Okay, so I'm going to just ask you the following, and then I'm going to see what you say at the end of the 60 games, okay?
Okay.
We're going to talk about the management or the coaching. We're going to talk about the offense. We're going to talk about the pitching, and we're going to talk about the defense. So real quick, I want you to tell me what your thoughts are, again, or just thumbs up, thumbs down, or neutral about the coaching staff and management of the Tigers organization as we enter, or just started, I should say, this 60-game stretch, 2020, baby.
Well, for me, so the Tigers obviously are trying to make a push to upgrade their, analytics and that whole, department, and they've been behind, but they're starting to get up to speed.
They don't tape things on their players and have cameras out there across the way there at the Detroit Athletic Club dialing in some signs and stuff.
Well, that whole Altuve thing, I mean, pure speculation according to him, right? Who knows? God, those photos certainly looked a little bit incriminating, but they're trying to upgrade that. So for them to have a manager, more of an old school guy in Ron Gardenhire, to me, very odd. It just doesn't. It doesn't make a whole lot of sense. Gardy probably could have been here, right after Jim Leland ultimately retired. Maybe you put him in there instead of Brad Ausmus. Maybe something happened. Who knows? I don't know. Gardy's fine. He's harmless, but this is his retirement job. He's making $5 million a year to manage the team. There's no expectations. It's just the manager, in my opinion, isn't a big deal. I wish they would have gone with somebody a little bit younger, though.
Got it. Okay, so then we go to we talked about pitching. So again, summarize the pitchers.
Starting rotation is going to be fine. Nobody's talking about Spencer Turnbull. He had a really good spring training. He's had a very good summer training. If you've been paying attention and reading, some of the updates, because we can't really see, a whole lot. I think he's going to have a very good year. Matt Boyd is just as consistent as you're going to get in a starting pitcher. The wild cards are Casey Mize. Is he going to be in the rotation? Is he truly ready to go? And then Michael Fulmer. He slimmed down. He looks unbelievable. Is that elbow good to go? Is he really going to be back to the Michael Fulmer that we saw before? Is he going to have the movement, that we saw with his breaking ball? I don't know. That is a total unknown thing, I guess, at this point. But if they have that starting rotation and Fulmer is decently close to what he was before, and then Mize actually is ready to go, that starting rotation is going to be fun, I think. So I'm not worried about it. The bullpen, that's a crapshoot, and it's been for the last 20 years.
That's what I was going to next. There's this guy called the setup. Familiar with the setup guy,
yep.
The eighth inning guy, and then there's the closer. Are we going to need a closer? And if so, do we have a closer?
See, I think with the expanded rosters, I think it's going to be more of just a rotation. You're going to be able to throw more arms out there. Obviously, Joe Jimenez is that one guy that people, Tigers fans specifically, kind of gravitate toward, and they want to see him, a little bit more. But other than that, it's a complete unknown. This bullpen is going to be a smorgasbord of just a bunch of arms, and let's, I guess, see ultimately what happens. So I can't answer. I would expect it to be very inconsistent. We'll see if Jimenez can actually be a guy here moving forward.
Okay, so we got two more to go. But so in terms of management or coaches, are they thumbs up or they're just neutral?
Yeah, they're neutral. They are what they are.
Pitching staff, from starters to the closer to be named later, are we thumbs up or neutral?
I mean, the rotation, thumbs up. Okay. The bullpen, I would still say thumbs down. I don't think there's enough arms there. Yeah.
Okay, great. Now we're going to go to defense. I'm going to save hitting for last, so the offense. So let's go for defense. We're going to have any gold gloves out there in the hot corner? What do we got going on?
Is Castro going to take the job at short? That's something I really want to pay attention to and see what happens. I think in the outfield, they should be fine. Again, Jacoby Jones is a plus, defensive outfielder. I think he has a chance to be, okay for the Tigers here moving forward. Jamer Candelario, at third base needs to be a little bit more consistent, but, has shown an ability to field there. So Personally, I'm okay with it. I don't think the defense is where it needs to be, especially because you're going to have a bunch of young kids out there. So you're going to see a lot of mistakes. But ultimately, the defense, I think, should be a little bit better last year. Last year got really sloppy.
I heard Cameron Maven's back. Is that accurate?
Yeah, for the fifth time? Yeah, he's back. What kind of a role will he play? I don't think a very big one at all.
Okay, so the defense, you're going to give that just a neutral? Where are we at?
Yeah, I would say neutral. Hopefully a little bit more cleaned up than what we saw last year.
Okay, fantastic. Now let's finish with let's hit it hard with the hitting. What do you think about the offense?
It depends. CJ Crone obviously adds a heck of a lot of power, in that lineup, but are guys going to be able to get on base? That's one of those things. And the Miguel Cabrera being in the middle of that lineup, what is he going to look like? Is Nico Goodrum going to be a factor as, kind of that utility guy? He's shown something with his bat. He needs to be a little bit better defensively, to play a little bit more, I think, for Gardy. Other than that, though, I think it's really dependent on Miguel Cabrera and then who is around Miguel Cabrera. Where's Crone going to bat? Those are the factors, I think, that will ultimately determine how well they can put an offense together and how many runs they can put on the board.
Okay, well, we got a great start, 4 games in, the weekend series with Cincinnati, and we're just getting started with baseball. We're just getting started here at What Do We Do, baby. Love it.
Episode 9. Appreciate it, guys. We'll talk to you soon.
The opinions expressed in this program are for general information purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. It's only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risks and possible loss of principal capital. Please seek advice from a licensed professional.